Most investors focus on returns, but ignore the silent force that slowly drains their wealth. Taxes do not crash markets or make headlines, yet they quietly reduce growth year after year. Even strong investments can underperform when taxation is misunderstood or ignored. Knowing how taxes affect returns is not optional for serious investors. It is essential. In this video, you will understand how taxes reduce investment performance and how awareness changes long-term outcomes. Like and subscribe to continue learning how wealth is protected and compounded intelligently. 1. Taxes act as a hidden cost. Taxes function like an invisible fee on investment performance. Unlike market losses, taxes are predictable and recurring. Every gain that is taxed reduces the amount available for reinvestment. Over time, this compounds into a significant drag on growth. Many investors celebrate gross returns while ignoring net results. This creates a false sense of progress. A portfolio that grows quickly before tax may grow slowly after tax. Understanding taxation reveals the true performance of an investment. Wealth is built on what remains, not what appears on paper. 2. Compounding suffers under taxation. Compounding relies on reinvesting gains to generate exponential growth. Taxes interrupt this process by removing capital at every stage. When gains are taxed annually, the base for future growth shrinks. Over long periods, this dramatically reduces final wealth. Even small tax rates can create large differences across decades. Compounding works best when capital remains untouched. Frequent taxation weakens its power. Investors who ignore this reality underestimate how much long-term wealth they lose. 3. Short-term gains face higher tax pressure. Short-term investing often triggers higher tax rates. Rapid buying and selling may increase activity, but it also increases taxable events. Each realized gain creates an immediate obligation. This reduces flexibility and forces capital out of the system. Short-term strategies must generate exceptional performance to overcome tax friction. For most investors, this is difficult. Taxes reward patience and penalize excessive activity. Long holding periods align better with tax efficiency and sustainable growth. 4. Dividends are not always free income. Dividends feel like passive income, but they are often taxable the moment they are received. This reduces their reinvestment potential. Investors may receive cash, but lose growth power through taxation. The appeal of dividends must be evaluated after tax, not before. High dividend yield does not always mean higher real return. Understanding dividend taxation prevents misjudging income strategies and helps align expectations with reality. 5. Inflation amplifies tax damage. Taxes are usually applied to nominal gains, not real gains. This means investors pay tax even when growth only matches inflation. In such cases, purchasing power does not increase, yet taxes are still due. This creates a hidden loss. Inflation combined with taxation erodes real wealth quietly. Investors must recognize that real returns matter more than nominal returns. Taxes on inflated gains reduce true financial progress. 6. Turnover increases tax drag. Frequent portfolio changes increase taxable events. Every sale locks in gains or losses and creates tax consequences. High turnover strategies often suffer from tax inefficiency even if performance appears strong. Low turnover approaches allow capital to grow uninterrupted. Reducing unnecessary transactions is one of the simplest ways to improve net returns. Tax efficiency often comes from doing less, not more. 7. Timing of tax payments matters. Paying taxes sooner reduces long-term growth potential. Capital paid today cannot compound tomorrow. Deferred taxation allows investments to grow longer before obligations arise. The timing of tax payments can be as important as the rate itself. Investors who understand this focus on strategies that delay taxation legally and responsibly. Time is the most valuable asset in compounding, and early tax payments shorten it. 8. Tax planning is part of investment strategy. Ignoring taxes is not simplicity. It is neglect. Tax awareness must be integrated into portfolio design. Asset selection, holding periods, and income structure all influence tax outcomes. Smart investors design strategies that align growth with tax efficiency. This does not mean avoiding taxes entirely. It means minimizing unnecessary leakage. Proper planning improves outcomes without increasing risk. 9. Net return is the only real return. Gross returns may look impressive on paper, but they are largely theoretical if they ignore what is actually kept after costs and taxes. Net returns are what determine lifestyle security, flexibility, and long-term financial freedom. Two portfolios can show identical performance numbers, yet produce vastly different outcomes once taxation, fees, and timing are applied. Evaluating investments without considering their tax impact creates a distorted picture of success. Real financial progress is measured not by what is earned in theory, but by what remains available for future use. 10. Taxes reward discipline and structure. Tax systems are often misunderstood as penalties, but in reality, they tend to reward long-term discipline, consistency, and thoughtful structure. Investors who plan carefully benefit from lower effective rates and reduced turnover. Discipline becomes a financial advantage when decisions are made with time horizons and structure in mind. Proper organization transforms taxation from an emotional obstacle into a manageable variable within a broader strategy. Those who respect this reality focus on protecting capital rather than reacting to short-term changes. By aligning investment behavior with the rules of the system, compounding is strengthened instead of interrupted. Taxes quietly shape investment outcomes long before results are visible. Ignoring them leads to slower growth and unnecessary loss. Understanding how taxation affects compounding behavior and net returns changes how portfolios are built and managed. Wealth grows when strategy includes structure, discipline, and awareness. Like and subscribe to continue learning how intelligent planning protects returns and strengthens long-term financial success.